Hello, this is Andrew Faldy from stickytrades.com, and we're going to talk to you today about shorting Tesla. And I'm going to give you some strategies and tactics to help you navigate Tesla on the downside if you're interested in that. So, as we see, just as the time of recording this, Tesla has some relative weakness compared to the S&P 500, and it's had a very strong run recently. But if this relative weakness continues and the market were to pull back harder, Tesla could participate on the downside just in the short term. But really, what we're going to cover is not just right now, but systematically how a short signal performed as Tesla went from $10 a share to over $400 per share. And that may sound like trying to step in front of a moving train, but we're going to see here that you can navigate stocks like Tesla on the downside through these wild rides that occur in these highly volatile names. And then we're going to talk also about options trades to protect your capital and enhance the returns. So the wild ride I mentioned from 10 to 400, you see these massive, massive pullbacks, which create tremendous opportunity on the downside for short trades and bearish trades with options. And I'm going to share with you right now the surprising returns of this short only trading strategy on Tesla, which runs all the way through that time period I just showed you. And you can see the returns are quite smooth, quite consistent with only shorting the stock during that period. So we'll hop right into it so you know exactly how this works. So the setup is on a 60-minute bar interval. So that's hourly bars on your chart, hourly time frame. You're going to have two indicators to do this system. And the first is a 100 period, 100 bar simple moving average. And the second is an RSI with the default of the 14 period that will load. And the one change you're going to make is to set the level at 50, and then you're also going to set another level at 30. By default, it's probably 70 and 30 or 80 and 20. And actually, I do have to apologize. I'm going to have this corrected here on the next slide. It's actually 20. Okay, so 20 is the oversold level. So it's 50 and 20. All right, and you'll see that here in a minute. So the entry signal is if price is below the 100 moving average and RSI crosses below the mid-level, 50 is the middle. If it crosses below that, then that's going to be our short signal. And exiting is simply if RSI turns back positive or it reaches all the way down to oversold, which is the 20 level. So remember, it's set to 20, not 30, like it showed on that previous slide. So we're going to go through a few examples real quick just so you can see how the trades line up. And so we're going to zoom in on this one right here, and you can see that it's below the 100 moving average on the initial entry off to the left, the first arrow, and the RSI is crossed below 50. And then the exit, the second arrow, is actually both occurring, crossing back above the 100 and the RSI crossing back above. That's not very common. It's to have that always in sync like that. It just happens to be the price was hovering around that 100-hour moving average. So here we're going to zoom in on a larger win and see how that one's navigated. This is the same thing. It crosses below. It's below the 100 period average. RSI is crossed below. And the exit is also RSI crossing back above, but it generated a larger win because the trade is held for multiple days. 1, 2, 3, 4, about 5 days there. Then we're going to look at how a small loss is navigated. Same thing. This is just purely RSI crossing down, go short, crosses back above. We defensively get out of the trade because, as you know, it's a stock that can go from 10 to 400. You know, if you take this trade at 170, it could go to 250. So we got to be defensive and careful. Options will also help with that, and we'll talk about that in a second. And then here is the different exit when it reaches oversold. In the oversold level, a 20 RSI on an hourly chart is a high probability bounce entry. We're not using it for that at this point because it could continue to sell off and we want better risk adjusted returns typically than that. You need other signals and triggers besides that. But when you're there and you're short, you do not want to hold that trade on the short side. The same, by the way, is not true on the bullish side. We'll talk about that in other videos. But you can hold bullish trades, but it's really dangerous to hold short trades in the oversold territory. So just zooming in on that, you can see that as it reaches that oversold level, and I don't know if it's because a lot of people see it or it's just the nature of markets that oversold levels tend to lead to at least short-term bounces that we're able to cover that pretty near the low as it reaches that 20 RSI level. So with an options overlay, the goal is to increase win rate, also to make the returns less volatile by adding income stream and reducing tail risk. So small break-even trades can become winners, and that creates that smoother results. And then further, and in my opinion, most importantly, is you're able to define your risk in the trades versus the unlimited risk that comes with naked short selling a stock, which could gap significantly above you. So as you pick options trades, it's good to know what your duration is of signals. And the signals here on average last about 2 days, just over 2 days. Winners being longer, losers being shorter, but the average all in is about 2 days. So we're going to pick the first expiration with more than 1 day to expiration. And that typically will be, it could be 1 day, 2, up to 7 days in the chain. So all of those are effective. And you're going to have a 40 delta short and a 10 delta long. On the call side, this is a call credit spread. 40 delta short, 10 delta long. And I'm going to now show you 4 examples. And I like to show a mix. So a medium-sized loss, a small win, and a larger win. And that very well represents the kind of the statistics of this trade as far as like the size of the different wins and losses. And so that's why this is a good little basket of trades to check. And so we see on the first one, you see in the bottom left shows how much the stock would have made or lost in a per share basis, and how much the options would have made or lost on a per share basis. So the stock on that trade, with that short signal and covering about 2 days later, the stock would have lost $4.43 per share, but the option spread on that signal, entered and covered at the same time, would have only lost 97 cents. That's a significant difference in improvement, and that comes from a mix of premium decay and low gamma from a near to expiration spread, or just an out of the money, a slightly out of the money call credit spread. On the second one, what we have is nearly break even, but technically a small loss. The signal itself on just trading the stock would have lost 58 cents. And the options trade, it's not green just because it's better and it lost less. It didn't lose 47. You see the key there, it's a plus sign. The options trade makes money when the stock trade lost money. So instead of losing 58 cents per share, you're making 47 cents, holding just over a day. So you're getting in near the end of one day, holding through a day, exiting on the second day, really the third day, if you count the entry as of day one. And that premium decay allows you to turn a losing signal into a profitable trade. And here you see, I mean, we're just right there about break even. And the stock technically makes about 4 cents on this signal here. So we're gonna mark it as a win. But what happens with the options as you hold it just over a day? 65 cents per share in the options trade. So you can see how that constant accumulation of better and better trades is going to give you more consistent results using options. But here is the kind of the downside, or what you have to give up, is this really big win. If you're trading the stock, you can have a $16.38 per share win. With the options, though, because of a credit spread, you're limited to the amount of the credit received as the amount of profit you could make. You make $2.56. So you have less. So it's red, not because it lost, but because it was not as good of a trade. So the options overlay, basically you're getting the higher win rate, you're limiting your risk versus unlimited risk. However, it comes at the cost of, this is a more intense effort with manual trading unless you can automate it. And that's what we're going to be talking about as we introduce in the coming weeks the Automated Trading Collective at stickytrades.com. And I'm honored to be leading that, and I can't wait to tell you more about it. And I'll actually mention something else about that in a minute. But right now, I want to talk about something very, very important as it relates to this is, what about the upside? You know, we're talking about, yes, the potential for downside, maybe even in the short term, potential for more downside. But eventually, if the stock is going to recover and survive and possibly grow to new all-time highs in the long term, well, what are we doing about the upside and the upside opportunities in stocks like Tesla and Tesla itself? So what we can do next is I'm going to compare and combine the short only system that we just covered, which is the returns of the equity curve on top. And then I'm going to add in this long only system. And I'm not going to go over the details of the long only system. That is something you will get in the Automated Trading Collective, all the rules and how to automate both of these trades. The key here is I'm going to show you what happens when you combine these two. But before I show you the combined results, I want you to see, while they're separated, the inverse correlation at times. And you can see that at the very beginning of the returns, that the long only system, it starts off with an initial period of losing. So multiple trades in a row that are unprofitable. And if you look back up to the short only system during that same period of time, it has a surge in profits that, by the way, is more than the losses in the one below it. So here's what ultimately happens. Maybe it's about a little bit less than the one below it. Here is the combination of the long short trading system. Is you have big profit spikes, which, by the way, come from both long trades and short trades. And you have that more stair-stepping consistent pattern in the results. And really, those early results there is before Tesla really became a strong performer. And later on, as that volatility really picked up and really got wild, you start capturing wins on the upside and the downside. Both systems being profitable typically at different times, sometimes at the same time, but combined, creating a smoother return and experience. So when you add automation, especially if you're adding automation using options like we'll talk about in the Automated Trading Collective, but we talk mostly about stocks, but we also include options. That's a great way to hedge core positions. So if you're long as an investor, long-term for Tesla, you can add automation with stock trades or options trades that hedge and offset that risk you have in a long-only position. You can be in more good trades. When I say more good trades, maybe right now you're comfortable managing 5, 10, 15 symbols, and you go through those and you see those positions. But when it gets to 20 and 30 and 40, it becomes overwhelming and too much to manage. Well, with automation, you can do 50, 100, 500, or 1,000 different symbols through automated systems and have that wide diversification of opportunities. And that brings us to the final point, which is on this slide, which is you can have smoother returns when you have uncorrelated assets and uncorrelated trading systems, especially when they're alternative style like long and short and options trades. You can really produce the best consistent long-term results. So if you're interested in the Automated Trading Collective, first thing, if you're not subscribed to this channel, then you're probably going to miss some of the announcements in the future. So go ahead and subscribe. But also, I'd like to hear directly from you, as we are just weeks away from the launch at this point. So you can email me, andrew.faldy@stickytrades.com, and let me know you're interested in automated trading. Let me know that you saw this video, and that's where you found the email and wanted to reach out. And also let me know if you have any questions. I'd be happy to answer those in the meantime. So for now, enjoy, watch this video again, learn this trading system, experiment with it, and I look forward to presenting more in the Automated Trading Collective.